Once again, thank you all for joining in. My name is Shashank Randev, founder VC at 100x.vc. I'll take another 30 seconds uh, and wait for folks to join in. Again, if anybody is facing any issues with the audio, do ping us now or during the course of the presentation. So great. I think we've got a fair number of people logged in, and thank you all for being here. Um, I hope all of you are doing well during the current times. It's a unique situation for all of us. We're getting used to working efficiently uh, during this COVID-19 situation, and it's been an interesting 3 weeks for all of us uh, on the startup ecosystem side, um, whether it's the investors or whether it's the startups. So today, over the next 45 minutes, I'll take you through 20 odd slides and share my perspective on investor relations for startups, particularly in the times of COVID-19. So just to get started, my second slide would have our contact details. If you're a startup, you can send us your pitch deck at pitch@100x.vc. For this particular session, if you've got certain tweets, please follow and tag us on 100x.vc. Sorry, 100x_vc is the Twitter handle. My personal Twitter handle is Shashank Randev. And we'll get started and dive into the investor relations. So we can move to the next slide. So, investor relations during COVID-19 is, it's interesting how everybody is a little wary these days of how things are going to evolve in the coming days. And, investor relations plays a very important role in any, process of building your business. It's an essential part of any business with investors. You absolutely need to have a strategy for maintaining them. Yes, uncertainty is in the air and investors are cautious. And while this is happening in the public markets, the private market is deeply connected because it relies on information that is readily available in the public market. That is market prices or valuing a startup, and this is where startups need to get their game up on investor relations to maintain and increase current and potential investors' trust and confidence. So, teaming up with investors such as business angels, venture capital funds, or strategic investors can significantly accelerate young companies' development. At the same time, it comes along with certain obligations that you need to deal with as a founder. So, investor relation is often confused with investor communications, but it's more than that. So, what is investor relations? The term investor relations for young and not yet publicly traded companies, the so-called startups, can be described as founders' contact with well-known group of investors. Example: venture capital investors, HNIs, family offices. So, developing, marketing, and communicating the company's story to achieve a market valuation that reflects understanding of business growth and how the company will build value over time. So, in the next slide, I'll talk a little more about uh, what it should include. So, investor relations will include financial updates, business strategy, capitalization table, which is your cap table, management, and corporate governance. So, just like public market investors, private company investors like venture capitalists and angel investors need to know whether they should keep their money invested in current portfolio companies and invest in potential startups which they were in touch with a few months ago. So the question which is often asked is how often should you talk to investors? What should be the frequency? And over the next 2-3 slides, I'll talk about uh, why it's important to follow the intervals of talking to investors. So in my next slide, uh, the focus is on why, why should you be talking to investors when you're not fundraising? So should you meet investors when not fundraising? Absolutely yes. Each meeting is valuable. Uh, uh, it will provide a learning opportunity. Things which you might discover during those conversations would be what kind of insights does the particular investor have about your business? What does the investor like about your plans? What are their top concerns? What kind of companies is the investor looking to fund? So in all this, it's the sole caveat to this advice is that after you've raised a seed round, it's prudent to spend a few months focused exclusively on building and recruiting. However, once you think you're 6 to 9 months away from another round of fundraising, it's sensible to start doing occasional investor meetings. So reaching out to the right investor hence becomes very, very critical. And you know, you need to have the right set of investors. And how do you go about breaking that down? Why do you think investor in a particular segment would be important? So you need to go after investors with deep experience in your vertical, who have a deep understanding of your business model, who know your target customers with a perspective that resonates with you, type of an investor, or with an investor who has no experience with what you're doing. So, as an example, an investor with deep experience in your vertical would be if you're building an on demand legal advice marketplace. You might want to talk to investors who worked with other legal tech startups. Investors with deep understanding of your business model, requires, so you're essentially looking for an investor who's worked, let's say, on a city by city rollout, talk to a few investors uh, who worked on companies who've done the same thing, investors who know your target customers. So, if let's say if you're building an analytics solution and your first target market is e-commerce companies, then talk to investors who work with e-commerce companies to better understand those companies' needs and structures. The perspective point is more in terms of this could be an investor who has interesting insights on your product design or leveraging data or just coming up with new marketing strategies. The last one I feel is important, wherein uh, an investor who doesn't understand your space, their concerns and feedback will help you tailor your pitch to audiences that are unfamiliar with your focus area. And this is very, very critical in today's time. The last point on my previous slide is because COVID-19 has um, put us in a very unique situation, and we continue to do businesses. Um, Certain sectors have taken a hit. Certain sectors are prospering. You've got the online collaboration tools which are doing fairly well, and you've got last mile mobility as a sector which are not doing well. That aside, there are investors in the market who are constantly looking for newer opportunities. So, a traditional real estate or a traditional mobility sector investor might now be open to investing in, let's say, a SaaS platform, and he necessarily doesn't have experience in SaaS. So, therefore, it becomes very critical to identify investors also with no experience with what you're doing, because it will be interesting to see how these investors look at your business. Because going forward, I feel there'll be multiple type of investors the startup founders will need to pitch to, who necessarily don't come with investment background or investment in that particular sector. So that's my quick note on that. So on the next slide, uh, you know, so investors' feedback is valuable, uh, and uh, and while it's valuable, uh, founders cannot forget to focus on the business. So recruiting, sales, and building a great product are more valuable and inherently is the way to get an investor interest. So when you're not fundraising, allocating 1% or 2% of your time to talking to investors is sensible. Allocating a larger percentage of your time is possibly not. So take a few investor meetings a month if you want to do that, but not much more than that. This means you're essentially talking to, let's say, 30 odd investors in 3 to 4 months, and they need to be meaningful meetings. So during those meetings, obviously, how frequently should you reach out to a single investor? What questions should you ask, and what questions should you be careful with? So I'll touch upon all three of these questions in a little more detail. So answering the first question in terms of how frequently you should reach out to investors. So if you're not fundraising, you should aim for meeting with any specific investor once, maybe twice, before going out to raise more money. The first time you talk to an investor, you'll each learn a lot about each other. You'll learn about what the investor is looking for when evaluating companies, their focus areas, what they would like to see your company accomplish to fit their investment criteria. Taking more than one or two meetings to learn these things is a waste of time for both the sides. So, very strong follow up to an investor meeting would be to return in a couple of months later and say, you we connected, and these are the updates from our side. And if you're still interested to chat up, I'm happy to share this XYZ update at my end. What questions should you ask? Now, be careful when soliciting a product feedback. Now, opinions on your UX design or features to implement or sales messaging are nice, but very easy to get wrong. So, for product related questions, customer feedback, or better yet, data on customer behavior, trumps investors' feedback by a wide margin. So, investors' product opinions are less meaningful because they are not the target demographic for your most products. The problem with the product feedback is that most people can't predict how a group of users will behave. So when building a product, trust aggregate customer feedback more than an individual user feedback, hence an individual investor feedback. So think about what questions you need to ask to an investor, which will help you, get a sense of how the fundraising can come through. I basically touched upon questions which are most relevant, and how to get a perspective of the investor and what they're thinking about your business. So, whenever you meet them, your objective should be what aspects of the company excites them. What do they think about your biggest challenges in the next 6 to 12 months in 2020? Does this company fall in their investment focus area? What would they want to see before deciding whether to make an investment? And what advice would they have for you in the upcoming year? So, good investor relations are the key to the future funding. So, in slide number 11, and this one is a very important one, I feel, and I'm going to spend some time on this, is managing investors is very, very essential. And while founders often feel investors are sufficiently updated, only 50% of the investors feel that their current and potential investee startups keep them sufficiently updated. So keeping up to date on KPIs, financials, key initiatives, and big hires is very helpful. to having conversations rather than starting every conversation with a level setting update. Uh, Transparency here really pays off, and I cannot emphasize more on that. Become more transparent in your communications. Your investors will be able to sniff out the times when you're trying to hide something. If you're falling on hard times, let your investors or potential investors also know ahead of time. Look ahead of the next quarter and realize that your core investors will stick with you if you tell them the truth. If you lie and then get found out, everyone will leave you. I'll touch upon the points in detail in slide number 12, where importance of investor relations for startups, and and these 5 points I think are very important in building a long lasting relation with your incoming investors and existing investors. And I'll talk about these points in detail. So starting with the first one, giving information that they want and need as investors. So investors want to see a lot of things, but they don't want to see you lose their money. That's as simple as it can get. So they have vested interest in the development and progress of your business, and founders need to know that. And investors are looking for business owners who are organized, responsible, and transparent. So think about the three C's while giving them updates. Be very clear in your communication, be very concise in your communication, and be very consistent in your communication. Give them your most important numbers first. They'll be looking for key performance indicators, which are always known as KPIs. Offer at least 3 to 5 metrics related to profitability, progress, and customer engagement. Impress them with sales numbers for new customers, large sales, and repeat customers. And let them know you're ready to add new products or services to your lineup, or whether you have new ideas in the research or production stages. And don't forget to update them about the facets of the new of your businesses. Get them excited about bringing on talented employees, new marketing strategies, media releases, and other exciting changes. Second point is, don't avoid contact with investors when progress is slow. This is very important for some of you um, who have been affected due to COVID-19. So while COVID is existent today, it will. These are uncertain times. We don't know how long this will go on till. Um, Maybe it will take us the next 6 months, and some of your businesses will deeply be affected because the nature of your business was possibly in terms of some of you must have been in and are in consumer facing businesses, and it will be tough in certain sectors, but things will revive. Things will come back to normalcy in a different way. But people will get out. People will start buying. People will start consuming the way they used to, and the cycle will come back to normal, and that's when your investor relations will come into picture. But for that, you need to start working now. And hence, don't avoid contact with investors when your progress is slow. So, what if your news isn't that great? Contact your investors anyway. Let them know. Investors may be inclined to get more involved when problems creep up. Things are slow. Use this as an opportunity to keep them engaged. Take advantage of their knowledge and expertise. Heed their guidance and support early on. Don't wait until things spiral out of control. And this is not only for your existing investors, but also building that relationship with your potential incoming investor. Maybe they were at the edge of investing into your company and now are rethinking it. And with you constantly giving them an update, will keep them up to date, and maybe their thought process of coming on board will still follow through. So very critical to to communicate with investors, no matter what stage you are at. Align roadmap and focus KPIs and metrics. I've already touched upon this briefly in the previous slide, but to avoid misunderstandings and at the same time benefit from your investors' expertise, I recommend regularly aligning your roadmap and most important priorities with your investors. So whether it's board meetings, and for an example, is a good way to kind of share certain topics and really align your KPIs. Uh, Help them understand how you've broken down your quarterly targets and what are the steps you're taking to achieve them. So this really works a lot. While all of this is happening, the key objective here is building investor relations and keeping investor relationships strong, right? And that's a work in progress always. Just as fundraising, managing relations to existing investors is one of your key responsibilities as a founder. And all founders need to be very cognizant about this. So it often accounts for a significant amount of time and does not have direct impact on business operations. Still, it is a useful investment of time as it lays the foundation for a well-functioning founder-investor team. So to ensure the efficient distribution of responsibilities, one person, typically the CEO, should be responsible for managing investor relations and involve the rest of the founding team whenever it's necessary. So the key to keeping investor relations strong is to communicate with investors, as I've emphasized over the last few slides. And there are many ways to communicate. The method doesn't really matter unless the investors specifically ask you to communicate with them in a certain way or at certain intervals. You can pick up a phone, call them, leave a message, send them an email, or catch up, over an online chat if that is a possibility. Start a monthly newsletter. Add them to your mailing list. Guide them towards certain section of your website which has more information and updates about your company. So these are various ways of building a strong investor relations, and it is more important today than ever because in a downtime you have the opportunity to build out your capabilities, rethink, look at how you will do or plan the next steps over the next 6 8 months, and keeping investors and identifying those investors become very critical. So in my next slide, slide number 13, you know, again, I've touched upon these points. So how can you leverage your brand footprint? You need to constantly communicate your growth strategies. So, and in these constant communications, how are you continuously growing in terms of users? If you're not due to XYZ factors, what is the pivot or product innovation you're bringing into, which will then help you increase monetization or create extensive opportunities for you and for your business. Also, execution, your monthly rolling business plan, which I touched upon in the previous slide, methods for delivery, product and service consumption. How is the product and service consumption, likely to be consumed? Your go-to-market strategy in terms of distribution partnerships, sales channels. What have been the updates? So, communicate these growth strategies. These are numbers. These are figures. These are the themes which excite investors. They look for these broader aspects in any type of business, and these principles, these nuances, are applicable for all types of businesses. So, slide number 14, I'm going to spend a little more time. While it's very obvious, but I think it couldn't emphasize more on this slide and than ever. It's obvious that social media is critical in today's time. Searching for the new investors that you need to make your business grow through social media is very critical. And I'm surprised actually in terms of my interactions and our interactions, our partners' interaction with some of the startups we've interacted over the last few months, and even over the course of our experience over the last few years, how lightly they take social media. They're building out great businesses operationally, in terms of IP creation, but they just fail to understand the importance of social media, maybe it's a way to this is a time to understand and speak with founders who started their businesses, let's say 20 years ago, and while they were still building out good businesses, the ability to reach out to new set of investors was different, was slightly tougher. In today's time, you have the ability, as a student, as a graduate, as a first time founder, to reach out to any kind of investor, from a growth stage VC fund to a large HNI, through LinkedIn, by just sending him or her an invite, and possibly making that invite conversation interesting for them to respond. So, so the so it's given power to today's founders, and we need to be very cognizant and not sideline the social media angle. So when you're trying to work with investors, you do not have to work, in a traditional manner. Your investors are necessarily and for sure more technologically advanced than you think they are. And possibly if they're tech investors, they've been only investing in online tech or tech-enabled startups, and they would be much, they'll be happy to reach you, get connected with you online through any social media medium. And when you are utilizing social media to find investors, you can make your business look more modern and appealing. And searching for the investors that you need to make your business grow is easy, if you know which investor to go after once you've done your preliminary research. How do you go about doing this? Start a blog. Write about issues and trends in the industry. Engage your customers and build up a clientele. Get your investors to follow your social media channels. Seek out sources where they get their information, and try to become a contributing writer to those kind of companies, which is again, as an article being posted online. And if you're successful, it gives you instant credibility. Founders need to leverage social media, through their own personal network. Need to reach out to investors through their own set of connections, whether it's their alumni, their ex-colleagues, through their common LinkedIn connects, asking for references to particular venture capital funds, family offices, which increases their success ratio of getting the first meeting, which is very, very important, because investors prefer to have get into a meeting if it comes through a reference. That's always beneficial. So slide number 15. While you're doing all of this, it's very important to communicate why is this the right time for your startup. As I touched upon briefly at the beginning, COVID-19 has touched upon various aspects of our livelihoods, and certain sectors have done, they're doing well. The online collaborative tools have never seen an increase in their usage, while consumer-facing businesses, mobility have taken a hit. Travel tech and travel hospitality have taken a hit. So in today's time, while investors still continue to look at opportunities, how is your business relevant? Is something you need to communicate to your investors. How are you doing things in a better way? What's your roadmap for innovation? And within this entire situation, what's the cultural acceptance to your software product or solution? How are you reprogramming a consumer behavior? So as an example, for instance, Zoom is particularly doing well now, wherein even my mother and mother-in-law are using this software to do laughter yoga while they're lockdown, we're in a lockdown situation. So Suddenly, Zoom as a software now has a new set of age group as users for their client as a client, which is essentially falling under 50 to 70 years of age, which was not there before the COVID situation. So think of opportunities uh, during this time in terms of how your product or solution is going to be, reimagining the consumer behavior or changing the consumer behavior. So the next slide, slide number 16, is as real as it gets. You need to be talking numbers when you're communicating uh, in your pitch or in your email. And most of the times we've seen the founders want to communicate something, but uh, they're not very clear. It's very macro. It's very ambiguous. And while you might want, you, as a dream, you might want to become a big company, but your goal needs to be explicitly explained to the investor in terms of you intend to become an X million in ARR in the next 3 years. So that is very very key when you're talking to investors. Uh, Talking numbers is very, very critical. Slide number 17, numbers talk. So, because you're talking numbers, it resonates with the investors. All statements in a pitch deck have to have a number associated, a measurable metric. You can define your use case, your problem, your vision, but if it's not having a measurable metric, um, it won't sink through the investors, and in particularly in today's time where it is very very critical. Uh, Investors are wary, but despite the wariness, investors have always been adventurous. The angel investors have always taken the plunge in investing in newer set of sectors, and hence they'll continue to build upon and continue that adventure streak they have, but they still look at numbers, right? And if you are able to give a measurable metric around that, your chances of closing around becomes much, much higher. Slide number 18, uh, and just general quick tips. All of you are aware of these, but again, I just touch upon them very quickly. So, your email pitch or your updates need to be short, concise, which I already mentioned earlier. Keep it short. Um, Give investors a chance to learn something new. Make the investors feel the fear of missing out. If they don't invest in your company, what are they likely to miss out in the next 2 3 years? Investors mustn't feel awkward sharing the deal flow with fellow investors. It must feel authentic, and that's your greatest way of increasing your network of investors. If one investor likes what you send to them, and they want to get other investors onboarded and move forward. Images, advisory board, and customer case studies work. So have that in your email pitch, your updated pitch text to your potential investors or the current existing ones. Point investors to specific content which they should not miss. Any significant updates, any specific pivots, any new innovations need to be specifically highlighted. The headline and closing line must be persuasive with call for action and direct. Always attach a PDF, mention your contact details. Slide number 19. I'll spend some time over here, and this is universal, irrespective of COVID 19 or not. The reasons why startups fail. You build something which no one wants. It has always been the case, will continue to be the case. Lack of focus. You've gotten depressed. You've digressed from your goal. You've lost the intent to build something scalable. Whatever the reason is, but you've moved away from focus. Spread of investment is too thin because you were aiming to perfect one solution, and that's not the way businesses are built. You need to constantly pivot. Um, Lack of a team, single founder, is one of the reasons why startups fail. We've seen that a lot. So have a good team always. Founders tend to have a lot of pride. There's too much press, and they spend less time building what they're supposed to be building out. And that's one of the significant reasons why startups fail. The other points, you can have a quick read through them, but I'll just quickly browse through them. Taking advice from their own trusted people, but they're useless ones. So you possibly take a family and friend advice, but what you need is an external third perspective, industry perspective, and investor perspective to come on board and help you advise to scale, which you necessarily will not get from friends and family. Then not coachable, doesn't trust anybody. Founders need to be open to feedback. And then you raise too much money, and then your inability to inspire, and no X factor, hence unable to raise the next round. Um, the 10th point that we've seen a lot, and uh, timing. You need to be very, very cognizant of your product's timing. Is it ahead of time, before time, or is just too late? And founders need to spend a lot of time thinking about this point. Uh, and then again, 11th, which we see a lot, premature scaling up, hiring big boys early, overbuilding the product, GTM spending. So these are the reasons why startups fail, and the reason why I thought I'll add this slide to this investor relations presentation is because these basic principles still remain, irrespective of whichever time, downtime, market prices you're in. Uh, Founders still need to be very, very open to what they're building, because you're building a business. You cannot afford to be in love with your business. The business needs to make money, and whichever step you take needs to be towards that, towards building a new business. Slide number 20. So, so these are the closing notes which I have for the presentation, and we can then open it up for Q&A. I'll take another 5 minutes to close this. But so, as closing notes, point number one: learn the art of investor conversations. You think programming software is tough, but try communicating with investors to get their attention. Invest time on what you speak and what not to speak when pitching. So be very clear in terms of what you really want to communicate to the investor, because the investors are reviewing multiple business decks. Their attention span hence is very, very limited, and whenever you get the opportunity of presenting to them, utilize that time in terms of what you want to communicate, and what is important for that investor to get interested. Second point: build your own network of startup founders who've raised money and ask them for investor introductions. This works with investor appointments all the time. Third, solo founders have a tough time running both businesses and funding. So get a co-founder, split roles as funding and business. Both are are ongoing activities. Get a real co-founder who can contribute to help close the round. Slide number 21. Work hard on your tech, content, design, your elevator pitch, and the whole investment proposition in detail, especially numbers. Investors love founders, as I mentioned, who understand finance well. Genuine deals close the round quickly. Point number 5: if you have factored 2 months to raise fund spaces, multiply it by 3. So in essence, if you think you have a 2-month runway, if you think you'll take 2 months to raise a fund, that's necessarily not the case. It can take you 6 months, 8 months. So whatever the number you have, multiply it by 3. Plan for practical timelines. Fundraising takes time. It's not easy, but if you're at it, it will reap benefits, and the transactions will close quickly. 6, your ability to digest rejection and move quickly to the next investor opportunities helps founders raise funding quickly. So be cognizant. A lot of investors will not accept your business plan and might not be of their interest. So that's not the end of the road for you. You need to quickly absorb the information and move on, and because there are other investors who would be interested in your opportunity, and you need to constantly look at and identify these investors. The final point: rehearse, rehearse, and rehearse constantly. Your numbers should be on your fingertips. Your idea, your vision, your roadmap for the 6 months, 1 year should be on your fingertips. Your clarity needs to ooze out every time, every single time when you speak to an investor. So keep rehearsing these numbers, um, and 100x is an early stage fund. We typically invest in early stage startups, through ISAFE, which is India Simple Agreement for Future Equity, and the whole objective is to identify good scalable businesses and opportunities, and then take them to the next level. And our investment thesis is essentially, we look at the founding team, market size opportunity, business model strength, your unfair advantage, your unique moat, and conviction of a minimum 20x returns. So we've done 20 investments so far, and we are now working towards a class two, where we'll be investing in the next set of investors, in a next set of startups. So slide number 24 is the final slide. Uh, if you're a startup listening to this, email us a short blurb demo on pitch@100x.vc. My Twitter handle is Shashank Randev. As the final closing note, uh, before I take on to the questions, and there are a few, I believe. Um, so, your company may need additional funding at various points of your product development, business development cycle. Keep a database of current and potential investors. The more you get connected with this group, the more your network will grow. Hold these relationships close and get invested in their world as much as you can. And don't be afraid to send them potential deals from other startups. They're always on the lookout for the next hot product, and they'll be sure to remember you, that you connected them with a great deal. So with that, I bring my presentation to an end. I think we've got 10 odd minutes for a few set of questions. Happy to address them, and take a few questions. So I'm just going through a few questions. I'll try and address as many as I can. In case I've missed out a few, I will try and email you with my responses. So a few questions here. So Dipankar Ghosh has asked a question. Since the idea is to have periodical meetings, how do you do this? Why should they want to speak to us? So I'll try and attempt to answer this in two ways. So one is, if you are already funded, then there is an incentive for the investor to meet you periodically. So that shouldn't be a challenge. If you're not funding and you've been chasing two, three sets of clients or two, three set of investors, um, the objective is to push them for a meeting, uh, because they are on the edge, assuming that their product is something they're interested in, but they're not sure whether they want to come on board and invest in you. And hence, your periodical updates in emails in terms of those numbers will help you get them interested and move to the other side of the fence, and hence lead to a meeting. So I hope that answers your questions. It's basically work in progress. You need to ensure that the founders of the investors who've not invested, how do you get them to invest? And if that requires you to send constant updates, do that, so that at least it leads to a face-to-face meeting. I'll move on to the next question. So there's another question in what is the pressure on investors to step back from seed angel investments, as most companies are very early? So if I understand this question, usually seed funds or angel investors will move back uh, from a transaction if they're seeing an inability of the founder to have a vision over the next 3 to 6 months. Their ability to sell the ability of, let's say, their IP coming through, um, and and actually scaling, because the seed investors and the angel investors are hoping that when are the founders going to be able to raise the next round, and if they're not certain about that, if the founders are not able to raise a round, let's say in the next 6 to 8 months, or at least 12 months, then the incoming investors will have their own reasons in terms of why they don't want to come on board, and that could be a function of the ability of the founders or the team to not sell due to XYZ reason, the business and revenue size not increasing. So there are multiple reasons for that. Okay, so considering current situations, how is it going to affect the startups who are looking for the investor in next quarters? So we are in a unique situation. Um, I don't know how this is going to pan out, but I know for certain that uh, founders need to continuously build out uh, a relevant product and service over the next few months. If you're in existing consumer businesses or travel space, you will have a tough time over the next few months. So hence, your focus should be in terms of preserving cash. Reducing your burn rate. I'm not saying these sectors will not come back to normalcy, but it will take some time, and hence the only way to survive through this is to preserve cash. While on the other side, um, you know, funding will continue to happen in multiple sectors. So startups will get funded. The only challenge would be that there might be a delay in terms of evaluating a startup. At 100x, we are continuing to invest in companies. We become a little more focused in terms of which sectors we are sector agnostic as a fund, but we like to focus on certain sectors during this particular time. But that being said, funds are there out there, and investments are happening. So in some cases, startups who are looking to raise funding immediately might end up seeing a delay if the sector is not relevant in today's time. So that's my take on that. So it's a very interesting question asked by Himanshu. How much sales a VC would like to see before they call it a proof of concept stage? Our startup deals in consumer food and sell through our e-commerce website. So different stages of a company. Uh, uh, you know, the kind of investor you reach out to, uh, you need to be sure what kind of investors they are. So whether it's an angel investor looking at MVP or an early traction, a seed fund looking for a paid POC or a POC opportunity, best for a lot of first-time entrepreneurs building out products and solutions. Whether you raise money externally or not, it is always wise and advisable uh, to constantly build out a validated product before you reach out to investors in the market, because you are building out something which is going to be long term. I hope that is the case. That's why you started the business, and you need to then constantly put in your savings. And before you reach out to an investor, if you have a paid POC opportunity, let's say if it's a B2B company, you built a software and you've tested out in two companies and one is about to pay you, that's a good sense of validation. And this is universal, right? So if you reach this stage, it's always better. Uh, you know, 100x doesn't fund ideas. We do, invest in MVPs and definitely in early traction. But you need to have that. You need to have that sense of direction as a founder. Another question, and I'll take another 3 minutes, maybe 2, 3 other additional questions before I end the session. And so the next question is it the right time for travel tech startup? So the travel space is hit tremendously by COVID-19. And while you know, it's not the best time for travel tech companies to get funded. Is it the right time for travel tech companies to start pushing or start reaching out for fundraising? As I said earlier during my presentation, it's always a good time. How are you managing this current crisis? What is your travel tech company doing uniquely in terms of data, in terms of information? Uh, you know, in this type of crisis, or when this opens up, how is your travel tech company going to leverage information and get new set of users? Uh, you need to constantly update investors in terms of they might not be interested, but how are you more relevant? So yes, as a founder, not only in travel tech, in any sector, it is very important for you to constantly fundraise, but at least keep your investors or potential investors up to date in terms of where you are at in a given particular quarter. So we've got a question: post-COVID world, how would the valuations be looked upon? Uh, would they be going down for new startups due to economic slowdown and the rise of new startups due to many companies taking hit? So that's a great question. Um, yes, I feel the valuations, the bloated valuations will come down. We'll have a more realistic valuation game. And there'll be a market correction. As my partners at 100x, Sanjay, spoke during a webinar last week, that possibly the new type of unicorns would be 100 million USD unicorns, and which is not a bad way of looking at the ecosystem, because valuation is something subjective, or is a function of you raising subsequent rounds. But at this stage, when you're just rolling out a business, when you're just getting started, you need not worry about valuations. You need to be worrying about what you're building. Will it sell? Will it be adopted? And will you have a recurring revenue coming out of that one product, month on month, quarter on quarter, and year on year? Those are the questions which the founders need to answer. Valuation is a function of, if you're able to build and answer all these questions, the valuation will come into picture. And obviously, the higher bloated valuations come in possibly after Series A or Series B, and which again in today's time has been corrected, and which in a sense is a good way, is a good thing for the ecosystem. I'll take one last question. So the question is, how should a startup manage its time between product building and brand building during the initial growth phase? I think both go hand in hand. Uh, you need to do both. Uh, there are no two ways about it. You're building a product, you're building a company, you're building a brand, you're building a sales force, you are building investor relations. As a founder, uh, you need to manage time, uh, work extra, put in the extra hours. But all of this comes together. All of it needs to be worked upon. Uh, so it's 12 p.m. I've taken an hour. I'll take one last question before I end this. Um, and then, there are a bunch of questions. I'll be more than happy to answer them. I'll reach out to you individually. So the last question is, so what will be the impact of cross-border commerce platform for the next 2 years? To be honest, I don't know. I don't know how the impact will COVID-19 situation would impact the cross-border transactions. See, last mile delivery, in my perspective, will be of interest. And we're seeing that last mile delivery of vegetables, grocery supplies, even for children's milk, is of interest right now in India. but and that is the primary focus right now for a lot of people in various countries. They wanting to buy a typical Indian-made linen bed sheet and import and get it to, let's say, Dubai is not one of the priorities right now for people. But again, uh, it will open up again. But again, I don't have a absolute answer to this. So great. I have 2 minutes extra for a 1 hour conversation. So thank you all for taking out the time today and being here for this webinar. I hope it was informative. Do share your feedback. Do write into us any improvements on the content, any insights, additional insights which are required. We would be doing these webinar series going forward regularly. Yesterday we had one with our partner in Karpe, and tomorrow evening we have our CTO Vatsu talking about product development. And I saw some of you ask questions around product development, and I strongly recommend you join that webinar and follow us on Twitter, follow our page on LinkedIn for more updates on our webinar varsity sessions. And if you're a startup looking looking to raise funds, and you're building something which is very relevant in today's time, do send in your pitch decks at pitch@100x.bc. Once again, thank you all for your time. I wish you all the very best and be safe. Thank you so much.